Hello and welcome to another session of the My Solo 401k Financial, My Community Daily Webinar Series. We're excited to get started. I see that we've already got questions that have been chatted over. That's fantastic. Please continue to feel free to chat over more questions on this topic or either unrelated topics so that we can be sure to get to them all. Also, if you find this webinar to be helpful, please like this video as it helps us to get the word out to other solopreneurs just like you who might be looking to catch up on their retirement savings or otherwise secure their retirement. So that'll be greatly appreciated. So as always, the presentation is being provided for educational purposes only and should not be construed as tax, legal, or investment advice, nor as a solicitation. When making an investment decision, please consult with your tax attorney and financial professional. So today's topic is not too late for a Fidelity Solo 401k. How solopreneurs can open a solo 401k in 2026 and fund for 2025. So again, if you've got questions on this topic or even unrelated topics, please don't hesitate to chat over the questions now so that we can be sure to get to them all. All right, so we've got some questions in the chat. Let's get those knocked out now. First one is from T. Is there any reason not to transfer my voluntary after-tax mega backdoor money immediately into a Roth IRA rather than a Roth 401k? My thinking is that if I transfer the full amount every year, I will never have more than $250,000 in my solo 401k, and therefore will never need to submit a Form 5500 EZ. Is that correct? Both my solo 401k accounts and the Roth account are at Fidelity. Well, that is correct if the value of the solo 401k, including the value of any defined benefit plan that might be sponsored by the solo 401k, the solopreneur, I should say, if the value exceeds $250,000, a 5500 EZ will need to be filed. But if it never exceeds $250,000, then there will never be a need to file the 5500 EZ. Now, I will state for our customers, it's really not a big deal because we will handle the 5500 EZ for our customers. And we do that for no additional charge, right? Unlike a lot of other companies that may charge even thousands of dollars to file the 5500 EZ. So we do that for no additional charge. We just have to be notified in a timely fashion. So once the value exceeds $250,000, clients, their advisors will let us know so we can add their plan to the queue to take them through the 5500 EZ filing process, where we follow up to capture the financial information that we do not have since we do not have access to the accounts. We capture that financial information. We reach out to the client months before it's due so that we can tee up the 5500 EZ form. We tee it up in the electronic filing system to make it easy for the client, for the advisors, etc. And then we send a courtesy copy once it's submitted to the client. Now, as far as that decision, whether to transfer the mega backdoor Roth funds either to a Roth IRA or a Roth solo 401k, the good news is that with our plan, you have options. I mean, we were the first solo 401k plan provider to offer a solo 401k plan that allows for the mega backdoor Roth. And it's a two-step process when you make a mega backdoor Roth contribution. You first deposit the funds into a separate voluntary after-tax account and then transfer those funds either to a Roth solo 401k or a Roth IRA. So if you are correct, if you transfer all the funds out of the plan to a Roth IRA and the value never exceeds $250,000, then there will never be a need to file that 5500 EZ. Now, but there might be other reasons to keep the funds in the Roth solo 401k. For example, if the individual wanted to preserve the ability to borrow those funds, you cannot borrow funds from a Roth IRA. The rules just simply don't allow it. But with a Roth 401k, if you have a Roth solo 401k like the one offered by my solo 401k Financial, then you can take a loan from your Roth solo 401k, where you can literally borrow the money, use the money for any purpose whatsoever. When you withdraw those funds as part of the loan, it's not going to be considered a taxable event, so it's not going to be subject to taxes. It's not going to be subject to penalties, as long as it's number one, properly documented as a loan. So we handle the loan documentation requirements for no additional charge for our customers, as well as within the loan terms. So you're limited to borrowing no more than 50% of the balance, not to exceed $50,000, and then paid back according to the required loan terms. So you'd have to pay it back in either monthly or quarterly payments, equal payments of principal and interest. Interest is prime plus 1% or a CD rate plus 2%, with those payments spread over a 5-year term. So if you want to preserve the ability to take a loan, that would be a reason to transfer those voluntary after-tax solo 401k funds to a Roth solo 401k. Another reason would be if you're looking to invest those Roth funds into alternative investments. Because with our solo 401k plan, one of the top reasons the clients sign up with us is the ability to invest in alternative investments. Alternative investments such as real estate or crypto or private placement or pre-IPO stock, just to give a few examples. Whereas if you wanted to invest in alternative investments via a Roth IRA, it would have to be a specialty Roth IRA. And if you wanted to have checkbook control over the Roth IRA funds, you'd have to set up an LLC underneath that Roth IRA. Whereas with our Roth Solo 401k plan, you have the ability to invest those Roth Solo 401k funds directly into alternative investments. And you, as the Solo 401k owner, you are the trustee of the plan. So you have direct checkbook control over the funds. So that would be another reason or use case why someone might choose to keep their voluntary after-tax Solo 401k funds in the Solo 401k plan by transferring to a Roth Solo 401k. It's also noteworthy that when you make that second step of the mega backdoor Roth process, the second step being of transferring the voluntary after-tax funds to a Roth account, that is reportable on a Form 1099-R, and we handle that Form 1099-R preparation for no additional charge. Clients or their advisors just have to submit a form on our website that they can do easily and quickly 24/7 at mysolo401k.net/forms. There's one form if the voluntary after-tax funds are transferred to a Roth Solo 401k, and then a different form if the voluntary after-tax Solo 401k funds are transferred to a Roth IRA. Good question, T. Connolly. And I see you got a quick follow-up. I often see the recommendation one should immediately convert the voluntary after-tax contributions to the Roth. How quickly can this be done? Typically, same day. And the reason for that is that if there are gains that accrue on those voluntary after-tax solo 401k funds while they're in the voluntary after-tax solo 401k account, those gains are going to be taxable. Whereas if there are gains that accrue in the Roth account, those gains have that potential for tax-free growth, as long as when you ultimately withdraw the funds from the Roth account, you do it as a qualified Roth distribution. Great set of questions, T. Conley. So again, if you're finding this to be helpful, helping you feel more confident about your retirement future, please do like this video, whether you're watching this on YouTube or Instagram or X or LinkedIn, as that helps us to get the word out to other solopreneurs like yourself. So now let's go to Carol's question. Thanks for bringing the question, Carol. We really appreciate it. I need clarity on which form you provide to correctly report my solo 401k Roth funding contributions to the IRS. I've set up my Roth on the Fidelity platform, and I have made in-person check deposits at the Fidelity branch. Afterward, I've submitted the pre-tax to Roth solo 401k in-plan conversion form. Is this correct, and does this produce a 1099-R form? That's a great question, Carol, and it's a classic case because one of the top brokerage firm where our customers have their accounts at is Fidelity. So we don't hold or have access to any of our customers' funds, but at the same time, we're very hands-on in helping customers open up the accounts at the bank or brokerage of choice. And Fidelity is the top option as far as brokerage holding accounts. So clients come to us to get the fully featured plan that allows for the mega backdoor Roth, that supports the ability to claim $1,500 in solo 401k tax credits, that he allows for the in-plan Roth conversions, the loans, right? All the different use cases that our customers are using the plan for. Fidelity allows people that bring their own fully featured solo 401k plan to Fidelity. In other words, Fidelity will open up accounts for people that bring their own plan documents. So, as far as depositing funds into that Roth account, if you're making Roth employee contributions where you transfer money from your personal account or your business account to that Roth Solo 401k account, that contribution, that Roth employee contribution, is not reportable by the plan. It's not reportable on a 1099-R. It's just not reportable by the plan. So it would only be reportable if the business is taxed as an S corporation and you're reporting it on your W-2. So when you make that Roth employee contribution, you make it as an after-tax contribution. In other words, it doesn't reduce your taxable income now for the year for which you make the contribution. But if your business is taxed as an S corporation, even Roth employee contributions are reportable on the W-2. So it doesn't reduce box one of the W-2 because it's made again on a Roth after-tax basis, but you still need to report it on the W-2 over in box 12. Now, if the business is not taxed as an S corporation, let's say it's taxed as a sole prop or a single member LLC taxed as a disregarded entity, you don't even report Roth contributions. But now let's assume that you're looking to make a Roth contribution as an employer contribution. So not as an employee, but as an employer, which in our experience is not highly utilized. Why? Because even though Secure Act 2.0 now allows for employer contributions to be made as Roth contributions, for our solo 401k clients, this was not a big deal because they already had a solo 401k plan that allows for mega backdoor Roth contributions. And so you can more quickly and easily reach the overall limit by making mega backdoor Roth contributions. So it really wasn't something that was highly utilized in our experience, the ability to make employer contributions as Roth contributions, because for our clients, they already had the ability to make mega backdoor Roth solo 401k contributions. So they would just skip making employer contributions and instead just make after-tax contributions and then transfer to the Roth account. Because if you're making employer contributions as Roth contributions, you're still limited to a percentage of your self-employment income. So for example, if your business is taxed as an S corp, that employer contribution limit is 25% of your W-2 wages. Whereas the voluntary after-tax limit is 100%. So you can contribute not a percentage, but you can contribute 100% of your self-employment compensation, dollar for dollar, up to the overall limit. But if someone makes an employer contribution as a Roth contribution, they will deposit the contributions directly to the Roth account, just like if you're making a Roth employee contribution. But per the IRS guidance, that Roth employer contribution needs to be reported as tax deductible on the employer's return for the year for which the contribution is made, and then reported as taxable to the employee for the year for which the contribution is deposited. So it's going to reduce the employer's taxable income, just like any employer contribution. So it's tax deductible on the employer's return. For example, tax deductible on the 1120S, the S corporation return, if the self-employed business is taxed as an S corporation. But because it's ultimately being made as a Roth contribution, it still needs to be taxable to the employee. So the way that it becomes taxable to the employee is via a 1099-R that's issued for the year of the deposit. So if someone is making a 2025 employer Roth contribution, that'll reduce the employer's taxable income on the employer's 2025 tax return. But if it's deposited in 2026, it's taxable to the employee via 2026 1099-R. So if that is what's happened here, yes, you are correct. You would need to submit that pre-tax to Roth Solo 401k in-plan conversion form to give us the information that we need to prepare the 1099-R. Because even though you're literally putting those employer contributions directly into the Roth account, it still gets reportable to the employee via that 1099-R, just like if you had deposited first to the pre-tax and then moved to the Roth. So you don't literally have to move it into the pre-tax and then to the Roth. You can put it directly into the Roth. But to prompt us to prepare the 1099-R, it's going to look just like you had made a pre-tax to Roth conversion. So it's going to be taxable to the solo 401k participant for the year of the deposit, and to prompt us to prepare that 1099-R so you can report it and include it as taxable income for the year of the deposit, you would submit that pre-tax to Roth in-plan conversion form. Hopefully that helps. I made a lump sum contribution for the 2024 taxes, and yes, I have an S corp. Okay. My lump sum was the employer plus the employee contribution. So if you made an employer Roth contribution for 2024, but in 2025, and you haven't yet submitted the online form on our website to let us know, go to mysolo401k.net/forms, submit the form for the pre-tax to Roth in-plan conversion form. That form has been updated because now we're in 2026, but you would still enter the date of the deposit as the date of the conversion. And then based on that date, we'll prepare the applicable 1099-R form. So if you deposited the employer contribution for 2024 in 2025, you would submit the date of the employer Roth contribution in 2025. Hopefully that makes sense. So thank you so much for bringing the good questions. Again, if this is helping you feel more confident about your future, your retirement future, please like this video. Now let's go through some slides. So let's first lay the foundation with a discussion around the solo 401k eligibility criteria. So a solo 401k is for a solopreneur, a self-employed person. In other words, an owner-only business, someone who's self-employed and doesn't have any full-time W-2 employees. So you need to report earned self-employment income on your taxes in order to be eligible. For example, on Schedule C, if your business is taxed as a sole proprietorship, could be a single member LLC taxed as a sole proprietorship. W-2 wages, for example, if your business is taxed as an LLC, as an LLC, as an S corp, or just as a corporation as an S corp, or if your business is taxed as a C corp, or if your business is taxed as a partnership, earned self-employment income is income reported on line 14 of the K-1 that you receive in the partnership. The other piece of the eligibility criteria is you cannot have any non-owner, non-spouse, full-time W-2 employees. So a full-time W-2 employee is someone that works 1,000 hours a year with a year of service, or 500 hours a year for 2 consecutive years. Ultimately, a solo 401k may be ideal for consultants, realtors, freelancers, and other small business owners. So in terms of some of the eligibility criteria, some of the eligibility considerations, no, you do not need the formal legal entity like an LLC or an S corp. You could be operating without a formal legal entity, such as a sole proprietor. You do need to report earned self-employment income on your taxes. There's no minimum amount of earned self-employment income that you need to report in order to be eligible. In other words, this is not just for high earning solopreneurs, really anyone that reports earned self-employment income and doesn't have any non-owner, non-spouse, full-time W-2 employees working for any business owned by you or a spouse, if any, is going to be eligible to set up a solo 401k. Your spouse or business partner may participate in the plan as long as they are also reporting their own earned self-employment income, such as their own Schedule C or their own W-2 if the business is taxed as an S corp. You can set up a solo 401k even if you have a W-2 day job, even if you're participating in your W-2 employer sponsors plan, as long as you've got that separate earned self-employment income with no non-owner, non-spouse, full-time W-2 employees working for any business owned by you or a spouse, if any. Now, here we are in 2026, and many are asking, is it too late to open up a plan and make 2025 solo 401k contributions? Is it too late to have the account at Fidelity? The answer is no. So there is still a possibility for those late starters to be able to set up a plan in 2026 and make 2025 solo 401k contributions. Now, the details matter, right? So if the business is taxed as a sole proprietorship, could be a single member LLC taxed as a disregarded entity. In other words, an LLC taxed as a sole proprietorship. Those individuals could still set up a solo 401k in 2026 and make all types of contributions, including employee, employer, and or voluntary after tax for 2025, provided that they would have to make the employee contribution by April 15th, 2026, even if they file an extension for their self-employed business tax return. In other words, their 1040, since their business is taxed as a sole proprietor. Even if they file an extension for their 2025 1040, that would only give them more time to make the employer and or voluntary after-tax contribution. That employee contribution is going to have to be made by April 15th since they set up the plan after December 31st, 2025. Now, if they had set up the plan on or before December 31st, 2025, that individual would have preserved the ability to make all types of contributions, including employee, employer, and or voluntary after tax by their 2025 self-employed business tax return deadline, including any timely filed extension. So for those that signed up on or before December 31st, 2025, regardless of how the self-employed business is taxed, you would have preserved the ability to make the most types of contributions, all the contributions, with the most time by your business tax return deadline, including any timely filed extension. Now, for those whose business is not taxed as a sole proprietorship, let's say it's an S corp, a partnership, a C corp, could be an LLC taxed as an S corp or a partnership. If you did not set up the plan, whether with us or with someone else, on or before December 31st, 2025, then you missed out on the ability to make employee contributions, employee deferrals, also referred to as employee deferrals. But you still have time to make other types of contributions. So for those non-sole prop businesses, right, the S corps, the C corps, the partnerships, you could still set up a plan in 2026. You could still make 2025 solo 401k contributions, but you would be limited to employer and or voluntary after-tax contributions for 2025. And you would have to set up the plan in time to make those employer and or voluntary after-tax contributions by your business tax return deadline, including any timely filed extension. So for 2026, for sole proprietors, you still have the most options, right? There's a special rule that applies to sole props. Now, you wouldn't be able to make the employee contributions after April 15th, 2026, but here in January 2026, there's still time to be able to open the plan, open the accounts, and make all types of contributions for 2025. So there's no December 31st setup required under those Secure Act rules for sole props. Now, where does Fidelity fit into the mix? So it's important to understand that a 401k is really a legal entity. It's a retirement trust. Like any legal entity, it's the documents that create it. So our solo 401k clients, we are setting up the plan documents for those solopreneurs. In other words, we have an IRS approved plan, an IRS approved set of documents that we use to create a solo 401k plan for our customers. And our solo 401k plan comes with the most features because what you can do with your plan, whether it's mega backdoor Roth contributions, taking a 401k participant loan, qualifying to be able to claim $1,500 in solo 401k tax credits, that is a function of the documents. And so if you go to Fidelity and you open up a basic solo 401k plan, you're going to be using their documents. So it's going to be much more limited, right? But Fidelity, because they only offer a vanilla plan, their plan doesn't support the mega backdoor Roth. Their plan doesn't support the loans or the ability to claim the tax credits. But at the same time, Fidelity will still open up accounts for people that bring their own plan documents. So you can have all the advanced features, but still have your account at Fidelity. You can have your cake and eat it too. So here's a good slide as it goes over those critical deadlines. It's that business tax return deadline, including any timely filed extension. So a good takeaway is to sign up early, right? To allow for plan document and account setup. Now we at my Solo 401k Financial, we act very quickly. We prepare the plan documents within the same business day when you sign up. And then we'll help you open up the accounts at the bank or brokerage of choice. So we are not holding your money. We don't have access to any of our customers' money. Unlike a lot of other providers that maybe hold your money or will try to force you or guide you to go to a specific institution, we are totally neutral, right? So our plan is totally portable. And at the same time, we'll help you open up accounts. Fidelity, that's the top brokerage option for our customers. We've helped thousands and thousands and thousands of customers open up accounts at Fidelity for their solo 401k plan. So we'll help you get those accounts set up at Fidelity. And those accounts at Fidelity are totally free, right? Fidelity doesn't charge anything to open up the account. There's no maintenance fee. You'll have the ability to invest in the same type of investments you could make through an IRA at Fidelity. But then on top of that, because you have the plan document from us, and that's what governs the account, you can also invest in alternative investments like we talked about up above. So the mysolo401k.net advantage is Roth, all the ways to get money into Roth. Roth employee, mega backdoor Roth, employer Roth, in-plan Roth conversions. Another mysolo401k.net advantage are the tax credits. So just like with the mega backdoor Roth, we were the first provider to offer a plan that supports the mega backdoor Roth. We're the first provider to offer a solo 401k plan that supports the tax credits. So those tax credits are tremendous, as they more than cover our fees for the first 7 years. So setting up our plan, whether it's a basic plan that you're upgrading to our plan, or you're setting up a new solo 401k plan, will qualify the solopreneur to be able to claim tax credits of $500 per year for 3 consecutive years for a total of $1,500. Again, that more than covers our fees for the first 7 years, making it effectively free for the first 7 years. Compliance support. So we handle the 5500EZ, the Form 1099-R. We handle that for no additional charge. Access to alternative investments, the ability to take a solo 401k loan. And we prepare the required loan documents. So just like the 5500EZ or the 1099-R, where the clients just need to request it in a timely fashion, with the solo 401k participant loan documents, just request it when you're ready to take a loan. And then we'll prepare the required loan documents within 1 business day. So the advantages are tremendous. How to get started? Just simply go to our website, mysolo401k.net, click on open account. It's a straightforward application, just 10 simple questions. Once you submit the application and payment is made, we prepare the required documents within the same business day. So as far as that pre-tax to Roth in-plan conversion form, back to the employer Roth contribution, you only want to list the employer Roth contributions, not the employee Roth contributions. Great question, Carol. All right, so again, if you found this to be helpful, please like this video wherever you're watching us, whether you're on YouTube or LinkedIn or X or Instagram. We also want to invite you to our community. We have the largest community of solo 401k-preneurs, solo 401k advisors, just other interested parties. It's totally free to join. All are welcome. So please don't hesitate to join. You'll find a vibrant community with forums. You'll find a library of videos and webinars. So you'll find tons of ways to learn, tons of ways to share the knowledge. You can join quickly and easily at mysolo401k.net/my community. Awesome. Thank you, Carol. Well, looks like that's it for today's Solo 401k session. Thank you so much for investing your time with us. Your time is valuable and your retirement future is worth it. If you haven't yet, please like and subscribe so we can keep building this Solo 401k solopreneur community. We'll be back here tomorrow with more crucial content to help you secure your retirement.